to another edition of Investor's Guide. I'm Avni Raja. This is a show where we guide you and help you on how you can make your money work for you. So we're going to continue with our episode of understanding various kind of debt funds and various categories of debt funds, and today we are going to focus on liquid funds. It's a very popular category of debt funds and it has a very specific space in one's debt allocation in your investment portfolio. But to understand all of this, joining me is Feroze Azeez of Anand Rathi Wealth Management. Feroze, thanks for joining us, and today of course we are going to talk about liquid funds, which is like I was pointing out, a very popular category of debt funds. But first, before we get to how it fits into the portfolio, help us understand what liquid funds are and how do they work.
Like the name suggests, liquid funds are very, very liquid. So anybody who has monies greater than 7 to 10 days, if you have a payment to make, that money invested in the liquid fund will in turn be invested in bonds or government bonds or RBI bonds, as they are called as treasury bills, for 91-day periods. So a portfolio which a fund manager creates, which is very liquid, where an investor can invest for as little as 7 to 8 days, the fund manager buys bonds of close to 3 months or below. That's the mandate given to the fund manager, that he cannot buy bonds exceeding 91 days as an overall portfolio basis. So point is that if you have short-term monies which you have a predetermined specific need for, but there is some time away, like if you have 10 to 15 days more to make that payment, a liquid fund comes very handy. So that's one of the applications. The other is the emergency fund, which all of us actually keep aside for the rainy day. A liquid fund could be another mechanism where you can park this money. So basically, liquid fund is a fund which invests money in less than 91 day securities, and hence becomes very lucrative as a short-term parking as against a savings bank account for most people who have services.
Right. And just about a year back, in around October 2019, SEBI had introduced a compulsory graded exit load. And if you can just help us how that works and what does it really mean for an investor?
The graded exit load is very relevant from a corporate investor standpoint, because liquid fund as a category is the largest category, one of the largest category, with 4 lakh crores in that category. So what corporates would do is put the money on a Friday and take it back on a Monday or a Tuesday. So that was creating a lot of inflow and outflow. So graded exit load is nothing but if you invest today, there is an exit load if you exited 3 days from now, 4 days from now, and so on, so forth, till 7 days from the date of investment. So you have a penalty to redeem the money from a liquid fund within 7 days. So that's called the graded. The reason why it's called graded is it reduces with each passing day and becomes zero beyond 7 days. So this is to make sure that the corporate hot money which comes in and goes out in less than 7 days, which generally most of us can't visualize investing or parking your money for less than 7 days. So that's the introduction of graded exit load, which happened almost a year back.
Right. Right. And the other point you were talking about of how this compares to savings bank rates, if you can just give us a sense of the kind of returns that one can expect from liquid funds and how they stack up.
For the last 1 decade, they had a very big difference between a savings bank account and a liquid fund performance. But after this pandemic, government or RBI has brought down the interest rate, especially the short-term interest rates in the country. So the return now with the liquid fund is as little as 3 to 3.5% a year. So the difference between a savings bank account and the liquid fund as of now is negligible. But in savings bank accounts, there are a lot of conditionalities for you to make that interest which you make on the savings bank account. So liquid fund returns going forward will be less than 3.5% and above 3% for an investing time frame of 1-2 months. So this has happened lately, but I think still their relevance exists, because you may still want to have a short-term parking vehicle currently. So the difference, to answer your pointed question, of me, is negligible now between a savings account and
Right. So, for somebody who does have a short-term need to park their money, like you pointed out, or maybe even, park contingency funds, is a liquid fund something that you would recommend, or is it not going to make much of a difference whether it's in a liquid fund going forward or in a savings bank account?
See, I think, Avni, for the next few months, it will not make too much difference, maybe. But liquid fund as a category is relevant. This is only because of the steep fall in interest rates, which has resulted in the return going down. So for this financial year, especially till March, I don't see a reason why you would want to move your saving account balances to a liquid fund.
Okay. And what about the tax implications as far as liquid funds are concerned?
See, the tax implication, unlike in a savings bank account, are capital gains. So if you stay invested, you will get short-term capital gain. That's one of your alternatives. If you take a dividend option, you will get dividend, and dividend distribution tax will be deducted. So point one, Avni, so short-term capital gain tax is taxed as per the slab of the individual who is investing. So there is hardly any difference between what savings bank account taxation would have and liquid fund, unless you invest in a liquid fund for 3 big years, and that anyways doesn't make sense, because the objective of the scheme is not for a 3-year investment.
Right. So, Feroze, we've sort of talked about a lot of various categories of debt funds over the past several episodes. What would be the advice that you would have for investors who are looking to build their debt portfolio and plan their investments?
See, I think when a person has to build a debt portfolio, he or she needs to be clear of what are the categories which are contemporary. So in our opinion, the contemporary categories, let me list it down, is medium-term fund, banking and PSU funds, dynamic bond funds, and short-term funds. These are the 4 categories which you need to focus on from an investment standpoint in the debt side. And ultra-short bond funds, which are a good replacement for liquid funds for short-term bonds. So that's one which you have to keep in mind. And in the current situation, you have to be very cautious, especially on the debt side, because there could be some degree of fallouts from the entire lockdown and the economic slowdown which the country has gone through over the last 6 months. So that's the piece of advice on the debt side. Know what are the categories you will focus on, and be a little cautious. Eliminate those categories which are risky or very low at return, like a liquid.
All right, Feroze, thank you so much for joining us with all of that perspective and with those words of advice. On that note, it's time to wrap up this edition of Investor's Guide. Hope we've helped you understand what debt funds are, what the various categories are. We will, of course, continue to break down various different categories as far as mutual funds go in the next few episodes. Thank you so much for watching.